No compromise, no surrender. Wall Street is planning to eliminate crypto native companies like Coinbase and Kraken. Today, I'm going to be explaining why and how they plan to do this. There's a battle going on between Wall Street firms like JP Morgan and Bank of America versus crypto native companies like Coinbase about how American consumers can use their own money. Of course, the argument is not about giving U.S. consumers more choice about where they can deposit their hard-earned money, either as USDC stablecoins at Coinbase or at banks. It's actually about protecting banks' profit centers, paying consumers a 0.1% interest rate on their savings deposits while lending out that same money back to those consumers for a 15% interest rate and keeping that difference, net interest margin. That's what it's really about. Now, Coinbase is fighting for stablecoin yield rewards as it is in their best interest, but also consumers. But there is a key distinction. The people at Coinbase are very different from the people at Wall Street. Instead of trusting in a financial system controlled by a centralized party of unelected officials, they want a decentralized, trustless financial system, not controlled by centralized entities, but built on transparency, user choice, and decentralized governance. This makes sense, right? The lack of trust from governments destroying people's wealth for decades through unlimited inflation of fiat currencies is the reason why Bitcoin is so popular today. And the difference with Wall Street is that they don't necessarily support this whole crypto worldview of individuals' users' financial freedom, because this system of decentralized finance and stablecoin will actually cut into some of their profits. So a domino effect of this is fighting it on the political end, but also now literally trying to destroy those crypto native companies like Coinbase and Kraken. Here's how. Morgan Stanley, one of the biggest, oldest Wall Street banks, has recently introduced crypto trading fees at one of its divisions called E-Trade. Now retail clients will be able to trade assets like Bitcoin, Ethereum, and Solana starting out. The fee level to make these trades are much lower than what you see at Coinbase, Robinhood, and others. Let's take a look at some of the fees. So you can see that Morgan Stanley's E-Trade platform is going to charge 50 basis points or 0.5% on the dollar value of each crypto transaction or trade. This is particularly targeted to retail crypto traders who are particularly lower volume traders. So let's compare this pricing for traders who would trade under $50,000 per month. We can see Coinbase is at 1.5% for a simple retail interface. If you're using the advanced interface, you could be paying between 0.4 to 0.6%, depending on the exact amount. Robinhood is effectively at 0.95%, and Charles Schwab is around 0.75%. So you can clearly see that Morgan Stanley has undercut a lot of the main retail crypto trading platforms. And to add to that, Morgan Stanley isn't hiding anything about its exact intentions. Jed Finn, the head of Morgan Stanley's wealth management division, described this strategy as disintermediating the disintermediators. That's a key takeaway about Morgan Stanley's plan to eliminate other crypto trading firms like Coinbase, Kraken, Robinhood, and others. But I'm sure your next question is, how is Morgan Stanley able to push his fees so low? Let me explain. So let's break down Morgan Stanley's business and particularly the revenue for each business. In the recent first quarter of 2026, it had $20.6 billion in revenue. Out of that total amount, $8.5 billion is from its wealth management division. E-Trade sits inside this division. When you break down wealth management even further, about $1.1 billion comes from transactional, which houses the E-Trade division. So this transactional segment only represents about 5% of the total net revenue that Morgan Stanley makes. Now to note, transactional revenue is not only E-Trade trading, it also includes stock trading, commissions, and investment banking. So with this division just being 5% and E-Trade crypto trading being a much lower percentage, it's obviously clear Morgan Stanley isn't attempting to make a whole lot of money from having crypto trading. In fact, Morgan Stanley's real goal is just for crypto trading to be an introduction to other sides of his business, different products and services where it makes a lot more money off that same client. See, Wall Street banks don't just monetize a client in one particular business. It's usually through multiple businesses. One of the biggest businesses for Morgan Stanley is its fee-based accounts. So you can imagine a client comes in and is trading on E-Trade, crypto trading. Eventually, Morgan Stanley could upsell them to being in its fee-based accounts, where the client has a financial advisor and Morgan Stanley charges the client a 1% annual fee on the value of the client's assets. Now, Morgan Stanley makes this money whether the client makes a single trade. So this is how you turn a passive client into a profitable recurring source of revenue. Another way Morgan Stanley can cross-sell clients are through its mutual funds and ETFs. In particular, Morgan Stanley just came out with its own spot Bitcoin ETF just a month ago. And it came out with the lowest expense ratio or fee at 0.14%, undercutting almost all other spot Bitcoin ETFs. And the market has responded. I mean, just in 1 month, almost $250 million worth of funds have gone into this ETF. Lastly, Morgan Stanley has a whole consortium of financial services for clients. Whether it's retirement planning for 401ks or mutual funds and ETFs, tax or estate planning, or stock trading, bank accounts and savings accounts or lending, Morgan Stanley has plenty of additional products and services to upsell clients on. So we can see what Morgan Stanley is doing. The real profit center is for them to get you into their other consortium of products. So Morgan Stanley doesn't really care about making money on crypto trading fees. And this is the biggest risk for firms like Coinbase and Kraken because they do care about making a lot of money on crypto trading. And this will be a race to the bottom for crypto transactions fees. As more and more of Wall Street comes in, we're going to see those trading fees push further and further down. So what should you do if you are investing in crypto native companies who will be competing directly against Wall Street? You have to analyze their business models and see if they have any competitive moat to survive this. For Coinbase, it is trying to transform itself into the everything platform, whether it's offering stock trading, tokenized real assets, gold and oil and silver contracts. It plans to be everything for a client wanting to trade. And Coinbase is experiencing some growth. As you can see, the prediction markets and the derivatives are growing fast, but they are not growing fast enough to offset Coinbase declining spot trading fees. The main issue that remains even for these is that Morgan Stanley and other Wall Street banks can copy prediction markets. They can copy derivatives. So Coinbase is fighting back. It's changing its business model as well as making its organization more lean and focused on AI. For Kraken, the CEO is saying that the company plans to go public this year, but they are in a similar situation as Coinbase. So you better be analyzing whether their business model can actually survive against Wall Street companies and whether they have any competitive moat before you invest. My take is that companies like Coinbase and Kraken will ultimately have to become like Wall Street banks in order to survive. Because making money on crypto transaction fees is just not going to work. Think about what happened to stock trading fees years ago. They have basically gone almost to zero. And most of Wall Street makes its money on all of its other products and services. This is likely going to be the same thing that happens with crypto. Now, Coinbase and Kraken are smart. They both filed for their OCC charters with the U.S. Treasury Department. This gives them approval to be a federal money transmitter, sets them up with an account at the Federal Reserve, and puts them on a path to actual custody client assets. So maybe they are on the path to become Wall Street banks. But that's what's the angle on how integrated services at Wall Street banks like Morgan Stanley and JP Morgan plan to eliminate crypto native companies like Coinbase and Kraken who primarily rely on crypto transaction fees. Remember, we have to focus on the fundamentals. But what are your thoughts? Will Wall Street companies like Morgan Stanley or JP Morgan wipe out firms like Coinbase or Kraken? Or will these crypto native companies basically become Wall Street banks? Let me know in the comments below. If you enjoyed this video, believe it has some valuable insights, hit the subscribe button, turn on those notifications, and I'll see you next time.